Hello and welcome to Angel Insights, the show that delves inside the world of angel investors, brought to you by SyndicateRoom. I am delighted to welcome Modwenna Rees-Mogg to the show today. Modwenna is an experienced corporate financer turned entrepreneur, and she is the founder of leading private investor news service www.angelnews.co.uk, with the goal of improving transparency and accountability in the early stage investment market to enable it to grow and create win-win situations for all concerned. Modwenna has also recently co-founded CrowdRating, the ratings agency for equity crowdfunding. And in today's episode, we delve into why now is the best time to be an angel, what separates a great angel from a good angel, and how to utilise a network to ensure for maximum deal flow. But before we delve into the show today, would you like to win a signed copy of the fantastic Venture Deals by the investing titan that is Brad Feld? If so, all you have to do is click the click to tweet link included in the show notes on iTunes, and you'll be submitted into the competition. But without further ado, it is now time to welcome Modwenna Rees-Mogg. Modwenna, welcome to Angel Insights. It's an absolute pleasure to have you on the show.
Harry, it's great to see you.
Now, I'd love to start off by hearing, how did you get into the investing world?
I left my job in the city back in '96, ran away to the country to get married and have a family. By about '99, I was champing at the bit, wanting to start working again, and I started working with entrepreneurs, and then I got asked by a friend of mine to run a high-end investor club for angels.
You recently said that there's never been a better time to be an angel. Why do you think that is? I mean, what's changed in the entrepreneurial and the angel investing environment that's made you say that?
An enormous amount has changed. One of the important things is that the quality of entrepreneurship has risen through a mixture of sort of learning and engagement, ranging from sort of television programs like Dragon's Den, but also more and more courses and availability in business schools and universities teaching people about entrepreneurship. Mm-hmm. And there's also, which means there are better quality deals available. We've also got a really interesting theme that individual people are wanting to become more engaged with the investments they make and not just leave it to the professionals. So maybe having watched Dragon's Den 2, they fancy themselves sitting in one of those chairs and having the chance to make an investment and engage with a company. I think also we've got an enormous number of changes in the workforce, which have meant people want to empower themselves and set up businesses and take control of their own lives. I think they say a lot of people would rather work 70 hours a week for themselves rather than 35 hours a week for somebody else.
And you said there about an increase in the investors maybe being inspired by Dragon's Den style shows and educational things. Does that concern you then, having a maybe slightly proliferated market of angel investors? I mean, is it making it harder to get those good deals?
No, because I think there are more good deals around. And one of the points about angel investing is what's a good deal for one angel isn't going to be a good deal for another angel, because the value an angel can add makes a lot of difference to the success of the business. So with more opportunities around, there are more opportunities for different sorts of angels to find the right deal for them.
And talking of value add there of angels, you've seen numerous brilliant angels over the years, I'm sure, and some not so brilliant. So what in your mind separates the incredible from the, let's say, slightly less useful?
I think the angels who, well, let's perhaps talk about the angels who make money, because I guess that is the measure. There's that measure, and then the measure of do they add value. And in terms of making money, what I'm seeing is investors are getting a lot smarter about understanding the risks, making sure they do their homework about what they're investing in. I hope there's less people just going, oh, well, I'll just throw some money at that because it sounds good. And they're actually looking at the business and saying, even though the risks are very high, do I understand those risks? What can I do to help mitigate them? And all the other aspects of investing that are so important. In terms of the value add, I think the best angels are the ones who are quite emotionally intelligent and understand that there is a difference between being a business person managing a business and being an investor in it. The angels who I think get it wrong are the ones who think, if only I was running that company, it would work like this, without perhaps either communicating that or if they do communicate it, communicating the value they can add wrongly to the entrepreneur. if that happens, the entrepreneur will just start switching off and not be interested.
And you said there about investors doing kind of the proper due diligence before making the investment. What is the core KPIs that you would always look at then?
So my favourite actually is that the entrepreneur has more to lose by giving up than carrying on. I think that's the fundamental one. That, at all times or as many times as possible, the entrepreneur thinks it's still my best option to make this business a great success. I think as well, it's having businesses where the business model is suitable for angel investment. And that tends to be stuff which has got relatively low capital expenditure required to achieve the growth. And that's why so many investors invest in internet-y stuff and medical services, the sorts of things where you don't need to build a factory before you've even made a product.
Absolutely. And we said there about success in terms of angel investing with regards to financial success. And a lot of that maybe comes down to portfolio construction and how to get the most capital efficient portfolio in terms of returns. What would you say your approach would be then to portfolio construction? Do you like a diverse, wide variety, or do you like to hone in on fintech or consumer?
No, I think there's various strategies. So one strategy, if you want to be the value-added person, is to, I think, find 2 or 3 at any one time that you're actively involved with. Now, it's unlikely you're going to be needed to be actively involved every day for 10 years before the company exits. So you can build a portfolio whereby you have some little ones where you give quite a lot of help, and then once they get up and running and don't need your help so much anymore, you then find a few more. So over time you might build a portfolio of 5, 10, 15 investments like that. I think if you're going to go the other way, statistically, all the research suggests you probably need 30 investments to have a sufficient portfolio spread. Then you have a choice with portfolio investing. Do you try and maybe corner a whole sector and back everything in clever apps for food or whatever, or do you try and spread across many different sectors or a few? And I think that's the bit that's a personal decision.
What would you say yours would be then?
Mine? I'd probably do fintech and media and com because those are the areas I know best.
Okay, absolutely. And then you said there about the kind of activity of the investor within their portfolio company and how much they do provide. Is it often quite hard for angel investors to sometimes not get too involved and take a back seat? And how can they balance the advisory role with a very operational, hands-on role?
I think clarity is really important, and I think more important than anything is having the relationship with the entrepreneur that they sort of like and trust you and feel they can be honest and open with you, because the nature of the investment of raising money is that it's pretty much them trying to get money off you and you trying to decide whether you should give it to them. And you need to then move that relationship into one of partnership where you are needed and wanted. And that is an open and ongoing and flexible situation. Because I think some entrepreneurs find that useful, concerned investors who actually don't have much relevant experience just become a distraction when they're trying to get on with finding customers or improving the product or doing some marketing or whatever it may be.
And you said there about entrepreneurs liking and trusting their angels. That probably entails quite a lot of a relationship beforehand. So do you like to know the entrepreneurs well beforehand, or will you make an investment and would you advise making investments quite quickly and off the cuff?
No, I would. Well, actually, what I advise all angels I meet is the first thing you should do is meet other angels and find people who invest in a similar way and with a similar approach and with similar time horizons to yourself. Because if you think of the sort of triangle that is the entrepreneur, you, and your other investors, if you've got all the other investors and yourself thinking and speaking and talking along the same lines, that's going to be easier for the entrepreneur, but also easier for you. So that's the first step. Then I definitely think you should know people, really, though I do know investors who are happy to invest on the basis that they know about you or know from your reputation that they can trust you.
Absolutely. And talking there about kind of meeting a network of angels, where do you stand on the syndicated model of angel investing? I mean, we've seen a big growth in it. What do you think of crowdfunding platforms like SyndicateRoom?
I think they're fantastic because very few people have the sort of financial firepower to back a business all the way through every round and get it to exit. Therefore, being able to share your money across things whilst other people are also sharing their money across deals obviously makes sense. But actually, there's a more important thing. One is by being in a syndicate, you can lean on other members of the syndicate and they can lean on you, and that's only a good thing. And secondly, you have the advantage with many of the platforms where they are, preparing deals very well, and also they have they can get all the management and paperwork and structures and all those things that most people find it more challenging to spend time on because they want to spend time having fun thinking about how to grow the business.
And when looking for co-investors and your angel network, how should you kind of distinguish between the people you do want to be connected to and those that aren't so important? What should they look for in co-investors?
In co-investors, so I do think it's important that you have some sort of, I tend to use the word simpatico. I don't know if that's a word what anyone else uses, but you should be in sympathy and aligned with each other and understand objectives. That can have consequences because if you are all a similar age, that might mean in 10 years' time you're all getting quite old, and that might affect your investing strategy. So I don't think it's per se about age or colour or creed or sex or anything like that. It's about people where you have a connection with and you understand each other so that you can communicate because over the life of a deal, particularly when it's syndicates, you'll find that investors move to and fro in their interest in a particular deal. And so some people might get more interested for a while. Some people then might pull away for a while because they've got something else they need to deal with. So at least if everyone's on the same wavelength when they start, when that sort of movement in activity between members of the syndicate changes, it should be a fairly smooth process of transfer of whatever the role or activity might be. If you're all don't know each other, you're just randomly investing all over the place, you've added a whole dimension of trouble, I think, going forwards when there are debates about things like new funding rounds or when the company faces a big challenge, a commercial challenge or some PR nightmare or whatever.
And if a startup has more than one angel on the cap sheet, as they traditionally do, and in this syndicated model, how should they know who should be the lead investor?
Well, first of all, the lead investor should not be somebody who is putting in the most money. Because just because you've written the biggest cheque should not buy you the right. And you shouldn't want the right to do it because the lead is about the value-added bit. And the other characteristic of a lead is that you should understand that you're there to sort of work with the entrepreneur, but you are representing the other investors. And what tends to happen over time, I've watched sort of syndicates going clearly before recently it wasn't platforms, but old-fashioned syndicates. And the lead investor can go native over time with the entrepreneur and stop thinking what the investors might be thinking about. So there are two options there. One is you have a lead investor who's the sort of value-added person who goes, as it were, can go native with the entrepreneur, and maybe you then need somebody who is much more distanced and is just there to say, how is this investment doing, and report to us, and we'll report back. But they also play a very important role helping garner the views and opinions of the investors and communicating those views to the entrepreneur in one stream rather than every member of the syndicate having to communicate separately with the entrepreneur and take their time off growing the business.
And talking of the syndicated investing model, a very exciting new project for you is CrowdRating. So can you tell us a bit about the site, how you assess whether a project is a solid investment or not, and just a bit of background?
Yeah, okay, well, background is it's long been a dream of mine that I think the lack of independent research and commentary on equity, I'm not so qualified on debt, so I'm not going to talk about that, but on equity is a significant problem in the market. If you look into the quoted markets or even the semi-quoted, the AIMs and this as well, there is very little research and independent opinion which people publish. So we decided, Alex, Heath and I, to set up a ratings agency where it was we call it a sort of computer or a ratings engine with a human head on it. The idea that we use the efficiency of the internet and use the efficiency of processes for analysing information, but then taking that and actually putting a human interpretation onto that stuff rather than letting a computer decide what should happen.
So do you analyse in deal by deal or sector by sector?
Yes. So we're 3 weeks and 1 day old in terms of since we launched. So it's early days. But what we do is we cover campaigns on all the platforms we cover. So we very much enjoy doing the SyndicateRoom campaigns. And
thank you so much. I'll give you £20
they're all great.
later.
But it's very interesting. One of the things that's very good about SyndicateRoom is their comprehensive information that is provided, which makes gives us lots of facts to process, put into our ratings engine to process. And then what we do is we basically, if you can imagine, pour the facts into the ratings engine. It has about 60 questions, which are the sorts of questions investors ask. So I'll give one that's obvious because you could all work it out for yourselves, which is around management experience. So in our view, if you've got a team which has got entrepreneurial experience, evidence of success in the past, evidence of industry knowledge and understanding, that is a team which has more skills than a team which is somebody who's come from a different sector, knows nothing about the industry, knows nothing about growing a business because they've been in a corporate. So there's clearly a different score between those two people.
Absolutely.
So that's the sort of thing we ask, and then we have some quite rinky-dink clever questions which are quite technical, which would be quite hard to work out what we're doing, but it's all about taking the facts and interpreting it.
And then you give it a score? Is it like a...
Then we give it a score. So we basically rate management, product and investment. They get gold, silver or bronze in those categories and a percentage score. And then within each category, there are 3 sub-elements. So in management, we look at skills, we look at experience, and we look at commitment, because we also think that commitment's a very important issue, that how committed the entrepreneurs are to that particular project and how much time they're devoting will make a difference. That if you are full-time, 24/7, if not, 7 days a week, you are going to be putting in more hours, and that should have a much better effect than if you work on something 2 days a week.
And so how can we access this service? It's what's the domain name? What do we Google?
So go to crowdrating.co.uk.
Okay.
You have to register because the ratings we publish, we are appointed representatives of a firm called Sturgeon Ventures, who are a regulatory incubator. Okay. So they look after companies like ours from a regulatory perspective. And then you log in, and there are lots of different types of category you can log in as, whether it's an advised investor, a high net worth, a certificated, sophisticated investor. But I'm sure there'll be one that suits the person who goes to the site to look. And then you register as a simple sort of click-through email thing just to confirm you are who you say you are. And then you're in and you can enjoy looking around. And you can actually make comments on what we say because we are only expressing one opinion, which is based on our ratings engine and our interpretation of the results of the engine. So we have people who put up little notes saying that sometimes they say they totally disagree with us. And that's good because what we want is more and more independent comment and thought about deals.
Absolutely, yeah. And if it's okay with you, we're going to move into a quick fire round now.
Yeah.
So, your favourite investing or tech-related resource, other than CrowdRating?
Yes. The crowdfunding platforms, clearly. And followed by that, actually, I think CB Insights is really good.
Yeah, absolutely.
American
fantastic.
Free Newsletter.
And then the biggest misconception about early-stage investing?
I think the biggest misconception is people not understanding that you're doing it to make money. And at what spectrum does that become greed or betting? Everyone will be different. But denying yourself that that's why you're trying to do it and trying to think you're doing it because it's fun or is bound to disappoint. Because at least if you know you're trying to make money, then you can decide whether you care or not.
Yeah, absolutely. And what are the must-knows then to individuals starting out in the investing game?
The things angels must know.
Yeah.
Okay, so you must know that if you invest blindly or just chuck money in things, you may as well be throwing your money down the river.
Okay.
You must know that you need to do all the paperwork properly, particularly if you want the tax breaks.
Mm-hmm.
And always, for every single deal, pass it by your accountant. Okay. Even if you think you don't have to, because these schemes are not just a free ride, a free tax break.
And then finally, what's the next 5 years hold for you and for CrowdRating?
The next 5 years holds building a much larger number of important and deep relationships with this new generation of people who've understood how fintech is going to revolutionise early stage investment and entrepreneurship, and we will begin to be able to make a successful company. I.e., we'll take an idea and we'll actually know how to apply this strategy on a Monday and that bit of marketing on a Tuesday, and we will start making things like WhatsApp, where in 2 years they go from being to nothing to amazing.
Yeah, absolutely.
Rather than struggling along for years. So my dream would be in the next 10 years that the 3 to 5 year exit becomes real, rather than today the reality of exit is probably 7 to 10 years.
Yeah.
But actually, that would be my overarching ambition, as well as building the relationships. Clearly, making CrowdRating globally successful and marvellous and massively profitable and selling out for billions. How about that?
Well, Modwenna, thank you so much for coming on the show. I've hugely enjoyed chatting with you. It's been a real pleasure.
Likewise, thanks for such intelligent questions.
Absolutely fantastic to have Modwenna on the show, and a huge hand to her for giving up her time to come on Angel Insights today. And for the accompanying article to this episode, head on over to www.syndicateroom.com and dive into the Learn page, where all the articles from the podcast can be found. Don't forget, if you would like the opportunity to win venture deals by the legend that is Brad Feld, all you have to do is click the click to tweet link included in the show notes on iTunes. And before we leave you today, we would like to remind you that all investing is risky. Therefore, it is important that you do not invest more than you can afford to lose, and you do conduct the proper due diligence prior to making the investment. Thanks so much, as always, for your continued support, and we look very forward to seeing you in the next episode.